In this week's video, we will show why the stock market bulls have very little margin of error. Let's assume we recently picked up a brand new suit from the tailor and we're getting ready to wear it for the first time, and before we leave the house we check the weather and it says there's a 42% chance of rain. Logically, would we bring an umbrella with us? Of course we would. We would bring an umbrella to protect our asset in the form of a new suit. We consider our investments to be a valuable asset, and we have reached a point where the market model is returning answers. 42% of them are coming back either bearish or no in terms of bullish hurdles that have not been crossed. Thus, we're at a point, from an oversimplified perspective, there's roughly a 42% chance of bad things happening, or the current weakness morphing into a correction, but there's still a 58% chance that good things will happen and the market will right itself. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In terms of our weather analogy, this is the New York Stock Exchange Composite Index here. It's a weekly chart. This is the end of February 2014, and this is into mid-June. This is a full-bore bullish look here. This look here is a leave your umbrella at home look. You've got your new suit on, and the probability of bad things happening is not particularly high. It's not zero, but it's not high enough to take action and bring your umbrella. How does the last 4 months compare to this low risk and a high conviction period that occurred earlier in 2014? This is the same chart of the NYSE Composite Weekly as of the close on Friday, September 26th. This is a 4-month period. This is the last 4 months. This rising trend in stocks here tells you that the battle between economic bulls and economic bears, or the battle between the conviction to own stocks and the conviction to sell stocks, is clearly being won by the bulls or the conviction to own stocks. The fact that the NYSE Composite has made zero progress in the last 4 months roughly, this is Friday's close, if I draw a horizontal line and move back, it tells us in stark contrast to this lower risk period here, the battle between the conviction to own stocks and the conviction to sell stocks has basically been a draw over the last 4 months, telling us that the probability of bad things happening from a chart pattern like this is much, much higher. This market is much more vulnerable than this market here. Here, we have a lower high. The broader market, even though the S&P 500 made a new high in this period here on a weekly closing basis, the broader market, the NYSE Composite, is thousands of stocks, did not. Here's a high, this is a lower high. We made another lower high. We just made a lower low relative to this low. And instead of having a full-bore bullish look with price above both moving averages, blue above red and the slopes up, we have a full-bore bearish look on the broad NYSE Composite as of the close on September 26th. No need for an umbrella here. We need to have an umbrella here until this chart morphs into something that looks more like this. Remember last week we looked at the S&P 500 on a daily, weekly, and monthly time frame. This is the same chart that we looked at last week as of the close, a week ago today, on September 19th. As we noted last week, the daily chart had a full-bore bullish look. How does the market model work? It's based on observable evidence and hard facts, allowing us to push our personal biases and our personal opinions aside. Some examples of the questions on September 19th. Is price above blue? Yes. Is price above red? Yes. Is blue above red? Yes. Is the slope of blue positive? Yes. Is the slope of red positive? Checking all bullish boxes, telling us that the probability of bad things happening with a chart like this is relatively low. It's not zero. You can see when the market was weak here, the trend was strong enough for the most part for these moving averages to stay fairly far apart, and we didn't get close to a bearish moving average crossover. This is the same chart as of Thursday, September 25th, and you can see it looks quite a bit different, and the questions and answers are quite a bit different. Is price above blue? No. Price above red? No. Is the slope of blue positive? No. Is the slope of red positive? No. We have a lot of no's here, telling us that the probability of this market rolling over in a bearish manner is higher here than it was here, or even here. These moving averages are much, much closer together, telling us that the odds of getting a bearish moving average crossover are higher here than they were even here during this bout of weakness. This is telling you that this trend is stronger here than it was here, and this weakness speaks to increasing risk. We're talking in probabilities, so the probability of bad things happening has increased. It doesn't tell us that the probability of good things happening is zero, and that's why we still own stocks, and we didn't take our equity allocation to zero. We took our equity allocation to a point where it's in line with the risk-reward profile based on the close on September 26th. How much did the chart improve on Friday the 26th? The answer is not very much. We still have slopes down. We still have price below both the moving averages. Putting opinions and personal bias aside, the hard evidence in the math tells us that the probability of bad things happening is higher here than it was here. If this chart can morph back to a look like this, we're happy to scale back into a higher equity allocation. If this rolls over and morphs into a multi-month correction, we have already reduced risk and will continue to do so if the look of this chart and others continues to weaken. The CCM market model literally answers thousands of questions to monitor the market's risk-reward profile. It uses risk-on, risk-off charts. This one, the S&P 500 stocks, risk-on relative to the VIX risk-off. We've shown this numerous times for those of you that are new to the fold. When the ratio here was rejected at resistance, the stock market was weak. Rejected at resistance, stock market was weak. Bullish breakout by the ratio, stocks did well. Breakout failed, weakness in the stock market. This is as of last Friday. Bullish breakout, a retest, and we've got a full-bore bullish look on this ratio. When we originally presented this chart on short takes on September 19th, and the post is still there if you want to read it, we said our concerns would increase if support is broken near point C. Here's point C. One of the beautiful things of using charts and a system and observable evidence is you can't rationalize away what changes. Not only was support broken at point C, meaning our concerns have increased, but we went from a full-bore bullish look here on the risk-on, risk-off ratio to a full-bore bearish look. Does this mean Armageddon is right around the corner? No, it's just telling us that the probability of bad things happening is higher on Friday, September 26th than it was on Friday, September 19th. Therefore, it is prudent to have a lower exposure to risk assets such as stocks on September 26th relative to our allocation on September 19th. He said roughly 42% of the answers were coming back bearish at the top of the video. Chris, can you show us some other examples? Yes, we can, and we will. If the S&P 500 closed below its 200-day moving average, would we be more concerned about stocks? The 200-day moving average is used to monitor long-term trends. All things being equal, we would prefer to have price above the 200-day, and we would prefer to see the slope of the 200-day remain positive, telling us that the long-term trend is bullish. How does that apply to the present-day market, since we know that the S&P 500 is still above its 200-day? There are cracks behind the surface. This chart here, tracked by the CCM market model, follows the percent of New York Stock Exchange stocks that are above their 200-day moving average. This is a measure of market breadth. Healthy markets have broad participation. Weaker markets have indices that are rising with cracks and weaker stocks in the background. As of the close on Friday, September 26th, 51% of the stocks in the NYSE composite, which is a broad index of stocks, are above their 200-day moving average, telling us that 49% of them are below their 200-day moving average, which means we have a very vulnerable market, even from a longer-term trend perspective behind the scenes. Is this a showstopper? No, it's not. This is something that just needs to right itself relatively soon. A percentage in the 51 to 52% range, we would classify that as a yellow flag that's waving rather rapidly, rather than a red flag. However, here, market breadth is much, much stronger when the market made a high in June, and you can see 76% of the stocks, really closer to 78 or 79%, were above their 200-day moving average. When the market strengthened here, it was a much lower number, telling us that the percentage of stocks participating in this rally was lower than it was here. The rally that we had Friday really didn't put a dent in this, and this continues to fall. The bulls need this to morph into a look like this, and that's something that may happen, but as long as it stays in this form, it's telling us that the probability of the current market morphing into a correction is higher today than it was in mid to late August or in late June. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.